Well, as interest rates go up, I think that is an unavoidable problem for valuations in the tech sector, particularly for names that aren't profitable. And so you're probably going to see some pressure on names that are not profitable to provide a path to profitability or adjust their business model if this continues.
Hi, it's ggoernert, Senior Investment Advisor at Canaccord Genuity Wealth Management and ggoernert Wealth Management. Now, welcome to the channel where we help you make sense of the financial world. Now, today, beginning of 2022, I'm going to be joined by Canaccord Genuity Technology Analyst, Robert Young. Robert, how are you?
I'm doing just fine. Thanks for having me on.
Oh, always a pleasure. Happy New Year. We had planned this to coincide with the ending of you just coming back from the Consumer Electronics Show in the States, which didn't happen this year because it was virtual. So why don't we kick it off there? We always find a way to work around things, but I know you keep your eye on things, but what were your big takeaways from that event?
Yes, it was a hybrid show. I mean, there were people that went in person. I think a lot of people didn't. I chose not to because at the end of as it wore down towards the conference was shortened, and then there were a lot of companies that were announcing they weren't going to attend. So I decided to do it virtually, and that takes away a lot of the experience because it's a bit of a spectacle. You just wandering the halls and getting a feel for, all the different areas. What the most square footage is attached to, and if the drone section is big or small, it'll give you a sense of whether drones are going to be a big deal. And so you get a feel from just the osmosis of walking around the show. And so you lose some of that, but there was quite a lot of announcements that came out of it. There were a bunch of semiconductor announcements, both AMD and Intel. And so it sounds like that the competition for primacy in the CPU and the GPU is going to continue. Laptops are important again because everyone's thinking about buying a laptop for their new hybrid office environment. There's always a lot of display news around new TVs and OLED, which continues to grow, and there's bigger and better TVs every year. The one neat thing that I saw was the Samsung had a remote that doesn't require batteries. It actually takes power from Wi-Fi in your house. So
that's cool.
Yeah, it's like it parasitically takes energy out of the air ambiently. Yeah. So I mean, think about it, what a great, ecologically positive and user positive development. I mean, how many batteries, in landfill does that save?
Yeah.
And then there's
go ahead.
Lots of metaverse stuff, VR. I think a lot less than people expected. I think going into the conference, I would have thought that metaverse would have been everything, but like Facebook and Meta wasn't even there apparently. And then 5G is another pretty dependable trend over the last few years. And there's a little bit of a spat at the beginning of the conference between the government, the U.S. government, and some of the 5G carrier rollouts around some frequency overlap with airline equipment. And so that's been pushed out a little bit. So some of the air out of 5G kind of fell out, but there's still some interesting device announcements. Samsung had a device. A Chinese company called OnePlus had an interesting phone. There was NFT stuff there, which I guess that's the word of the moment as well. And so there was a lot of interesting stuff that came out of it. But I mean, I think we suffered from not being able to, wander the halls and sort of get a feel for it.
Yeah, well, why don't we, take a step back and just take a look at, last time we talked, the chip sector has been in the news for the chip shortage, but there's been some developments on the chip side too. Intel's got some new architecture coming out. That was hard to say. Why don't we take a step and maybe just overview what you're seeing on that side?
Yeah, well, 2021 was a really strong year for chips. We're seeing a lot of, supply chain shortages for chips. Chips have very long lead times, and so you have to order them way ahead of when you expect to use them. And so the hiccup at the beginning of it has sort of created this, cascading problem. A lot of the bigger players are saying this could extend into 2023, and so that suggests that we're going to see a lot of, a good environment for semiconductors in 2022. There's also this. Micron actually is one of the companies that reports a little bit out of the cycle. They reported at the end of December. They said that data center was up quite a bit. They said they expected 2022 to be a really strong year for PC, but shifting more towards enterprise, away from consumer. And so all of those are drivers of chips. And then of course we've got 5G coming, and we've got probably another device cycle. Everyone needs to get a new device soon, and so that's going to drive both semiconductors and also displays for the screens, because a lot of that is moving to higher quality OLED type of screens. And so if you look at through the entire semiconductor industry, you've got the end user, say Apple, who's going to put a chip into their device, and then there's the company that makes the chip, and then there's a company that actually manufactures the chip, and then there's a company that manufactures the equipment that manufactures the chip. And so all of these companies all the way through that ecosystem are likely to do well in 2022.
Yeah. Now, are we still seeing the chip shortage affecting automotive sales, and automotive, is that still a topic?
I think it's a trend. I think the automotive industry, they need chips that'll last for years. And so they typically use older process nodes that are more proven. And there's a shortage of the bigger wafer sizes in the older process nodes. And so that's going to drive some capacity expansion. And I imagine that eventually the autos are probably going to have to change how they engage with the supply chain, because they're used to other companies giving them just-in-time inventory, i.e. other people carry inventory for them. But the semiconductor industry doesn't work like that. The semiconductor industry says, tell us 6 months ahead what you need, and we'll have it for you. And I mean, the auto industry needs to adjust to that reality. But and then there's also the fact that chip count in cars is going up because of just modern amenities in cars, but then also autonomous driving, and then all the management functions around EV. There's a lot of increasing chip count, and so the percentage of value inside of a vehicle, inside of a Tesla, for example, I think anyone would agree that it's driven far more by semiconductors than, say, the chip count in a Toyota, right? And so as the industry moves towards that, you're just going to see more and more dependence on semiconductors and more, software and semiconductor content.
Yeah. Now you touched upon enterprise software. Now, I still think that we're at that stage where, I think anyone who works in any type of business, we're still tending to work a lot remotely here. That I still think there's going to be a big spend on enterprise software. What are you seeing on that side?
Well, I mean, valuations here at the beginning of the year have been pretty tough around this space. We've seen interest rates going up. The U.S. 10-year, the yield on the 10 years gone up. It's up now about 1.8%. It was down, quite a bit lower, under 1% last year. And so what that's doing is it's having an impact on some of the software names that aren't profitable. A lot of them are growing really fast, and to support that growth, they're spending a lot on sales and marketing and R&D, more than they were making. And so despite the fact they have very high gross margins, they're unprofitable. And so some of these businesses, investors are looking at them and saying, well, if I'm not going to get cash flow for a few years, if interest rates are going up, that cash flow several years from today is going to be worth less today. And so it's less valuable to me today, and valuations are coming down. There's some worry about supply chain issues. There's worry about flooding in Asia. There's a lot of factors that are creating some worry that the financial reporting that we're going to see in 2022 might be a little bit weaker. But I mean, if you look at the enterprise software space, there's a lot of trends that are supportive of a strong industry. I mean, there's a very strong trend towards digitization. Another company that reported recently, Accenture, another one that's a little bit off cycle, reported it near the end of the year. Very, very strong trends. They beat expectations, had a very strong outlook. And a lot of this is driven by large enterprise moving towards a more digital future, digitizing their operations. And so that's going to drive a need for enterprise software. And so there are a lot of very strong business models in enterprise software. They typically have very strong balance sheets. But the issue here is around the how do we value the cash flows if we're not going to get them for several years? And so we're seeing a bit of a differential between companies that are profitable and companies that are not. The companies that are not profitable, the valuations have come off quite a bit more, even though they may be very strong businesses.
Right.
And then there's also a view that if companies benefited too much, if some demand was pulled forward, then it's less likely that demand is going to hit us in 2022 and 2023 because there's going to be a catch-up period. And so, you think a company like Shopify that has, a very strong business model tied to a very, very strong long duration trend, e-commerce. And, I think most would admit that it's a strong, maybe even a pillar of that industry. But there's an argument that some of that demand was pulled forward. and they have been spending money aggressively to support a very high level of growth, which a lot of investors I think would normally think is very prudent because you want to take advantage of the opportunity in the most aggressive way possible. And some of these stocks have seen some of their valuation come off, whereas there's another group of stocks that have strong growth but have a little bit of profit, a little bit of free cash flow to go along with it, and those are seen as less fragile, a little less risky, and so there's a bit of a rotation more into those names.
Yeah,
But I think as a whole, enterprise software is still a very strong sector, a very strong business model.
yeah. Now you touched on NFTs. Why don't we just you said that was kind of a bit of a buzz in the space right now. Non-fungible tokens. Why don't we talk just briefly a little bit high level about it and some of the uses, because I am getting a lot of calls on this, but a lot of people don't really understand what it is. I thought some of the more interesting thoughts would be maybe, concert tickets might have an NFT component to it, for resale, and that might be pie in the sky, but I can kind of see some uses there. What are you seeing in the space from a high level?
Well, the big problem with the space is people don't understand what it is. That's the first thing. And that's not, it's not, I think that's a fairly common thing. But what it stands for non-fungible token, digital assets or crypto assets as Bitcoin and Ethereum. And Bitcoin and Ethereum are fungible. So one Bitcoin is exactly the same as the next. And so what a non-fungible token is, it's where you can assign value to something that might be unique. And so we're seeing its application in the art world and around unique assets. And it's very interesting because, say you are an artist and you're creating digital artwork. In the past, you might not be able to benefit from the fruits of your labor because you would sell your piece of art to someone and they would wait until you pass away. And then, of course, it would go up. Whereas if with an NFT, you actually keep a royalty, or you can keep a royalty so that every time your artwork gets sold, you get a little commission. And so there's some benefits that can be built into software. But at the end of the day, it's a way to track, assets that are not fungible, i.e. they're different. And it's using software based on the blockchain, which allows, a ledger to keep track of that asset in a way that people can't change it. And so there's like durability of the value, or at least someone can't steal it easily.
Right. Yeah, I know some of my people I know that are intimately into the sector right now are probably yelling at me right now for not pronouncing it properly, but I apologize to you guys. But yeah, no, I think it's an exciting sector, and I think it's something we're still beginning at, at the really, really nascent stages of rolling it out right now. So, outlook for the sector going forward, just the technology sector. We talked a little bit about valuations. We talked about the difference between companies that are high growth but not profitable versus companies that are profitable. And we're going to get back to regular business things of, net discounted cash flow and how that works with the yield curve. So it's going to be the boring business stuff that kind of drives certain segments. But when you look at valuations going forward for 2022, how do you see things playing out right now?
Well, as interest rates go up, I think that is an avoidable problem for valuations in the tech sector, particularly for names that aren't profitable. And so you're probably going to see some pressure on names that are not profitable to provide a path to profitability or adjust their business model if this continues. However, like I said, a lot of the companies that we track towards the end of the year, there's a bit of an air gap in reporting through the holiday period and through the beginning of the new year, just because no one's reporting anything then. But if you look back to just before, the companies that reported, Micron, Accenture, Jabil, Broadcom, Ciena, Oracle, these all had very good results. Some of them tremendously good, like Accenture. And so the business models are sound. And so I like to think of it as it's become a trading market. There's higher volatility, fundamental value is less important, and now the investor has to consider where they think that the valuations are going to shake out. I think anyone has to accept the fact that valuations in tech sector have been inflated, and they're still above the long-term average. And so there is a potential for valuations to come down, just as a group. But underneath that, the fundamentals, the companies, they're very strong, and they're tied to a lot of really strong trends. And so I think at some point this corrects. And we've been saying for a long time in the tech sector, buy the dips. And a lot of the time, these are opportunities where you you get the opportunity to buy a company when you might not ever. A good example of a company that underperformed its FANG peers in 2021 was Amazon, right? Although I think most people would accept that it's become a very important part of our life. And so it may be that, a very high quality company like Amazon, if their valuation come down, that is a very healthy thing, but it's a strong business. And I think we should still look at the tech sector as a fundamental piece of, the way investors look at their investment portfolio. And like I said, there's a lot of trends here. There's digital transformation. Companies are very aggressively embracing enterprise software and software in a way, that they haven't in the past. You've got this pressure coming from the metaverse, a lot of investment from companies like Facebook and Google. The semiconductor space, you got tight supply chains, a lot of investment falling into that space right now, likely at least a year of strength there. You've got very, very complex and disconnected supply chains. And so there's companies that are going to benefit from higher pricing in the supply chain, and also the likelihood that companies are going to spend more on software to improve their productivity. And so there are software companies that are tied very directly to the supply chain. And so, I think, what people keep saying is that this is becoming a stock pickers market. And I think that's kind of code for, all boats are not going to go up, because the tech sector isn't going to drag every single company in the space. You have to be cognizant of the relative value of the companies. And so I think at the end of the day, you want to look for good quality companies, ideally category leaders that are tied to themes that you believe in. And I think there's a lot of that still in the tech sector. And I'm very biased because I spend all of my time looking at technology investments, but the argument around valuation, the rotation of investment into value, that's a very interesting concept. And there's still opportunities in tech to take advantage of companies that have been overly impacted by the valuations correction. But there's also companies like in Canada like Celestica and Evertz that are relatively well valued or value companies. And so even within the tech sector, there's opportunities if there's a rotation towards value.
Yeah, no, and I think that's a really good place for us to leave off right now, because the key, what you're saying is, it's investing 101. Valuations matter, but buy the dips. I mean, things are going with. This is not, in my mind, this is not the 2000 .com bubble. This is, things get a little expensive because everyone gets a little excited, but there's really strong businesses there, and if you do your homework, I think things will be good.
Through 2000. I mean, I lived through that, and it's a different, like I said at the very beginning, the companies in the tech sector today have strong balance sheets. They have good, proven business models. The tracks for the internet have been laid, and businesses are building on top of them. And the next layer of investment is going to be this metaverse or Web 3.0. Yeah. There's a lot of real businesses that are making a lot of money, and in 2000 there were a lot of companies that were an idea.
Exactly. We're not there.
It's a much different situation now.
Yeah, no, absolutely. And I feel bad even bringing that up, because it's a totally different world from that. That was, your point is well taken. These are really strong businesses, and as I said, valuations matter. We can all do our homework. The world where we can actually do some discounted cash flow models on companies is a different world. You go, okay, well, what would you like to pay for that? Well, that makes sense, and you can work your way backwards.
There's the interest rate problem, right? Because if
exactly. Yeah, cost of capital is important. Okay, well, hey, why don't we wrap it up there? Want to see you again in a few months. Once again, Happy New Year. Rob Young, Canaccord Genuity Analyst. Bye, Rob.
Thanks, everyone. Have a good day.
Thanks for watching. If you want to see more content like that, please consider subscribing or join me on my website, ggoernert.com. That's ggoernert.com. Look forward to seeing you there.